Excellent. Well, thank you for your time today and joining us. My name is Daniel Evans. I'm a certified financial planner and financial advisor here at Bogart Wealth. Today's discussion, we're going to talk about the retirement planning, the timeline. And this is very broad. We're going to cover, a lot of different topics. The encouragement here is to engage in a financial planning session, and then also doing a deeper dive into the individual topics that we'll discuss today. As we get going here, I do want to introduce the firm a little bit to you guys. Bogart Wealth, as a firm, we manage about $3 billion in assets, 202.7 billion assets under management. That's roughly 1,300 households. Bogart Wealth is a registered investment advisor, which means we operate under the fiduciary rule, which we are bound to put your interests first. We actually don't hold assets at Bogart Wealth. We custody through Charles Schwab. As transparency and experience, we have no commissions, no incentives. The only way we get paid is on investment management. And then, of course, on the investment management side, everything is customized to a very high level to your individual scenario and situation. This is our team of advisors that we have. I will highlight James Bogart for just a minute. The guy has done a fantastic job of growing the resources and capabilities of the firm. And, as a testament to that, the number of clients, the assets under management have grown throughout the years. We do have full operating service teams. These are the folks that support and are often behind the scenes, but they make things go. We do run our investments in-house. Alex Spencer leads up our investment team, and they are housed in Virginia. We do have 3 offices. I'm here, and we're main office here in Woodlands. We got our headquarters in McLean, Virginia, and then we got a smaller office there in the Houston, Gessner area. So today's topic, retirement timeline, is part of our retirement readiness series. These are topics that we've received direct feedback that we want to engage in and go a little bit deeper from an education standpoint. And ultimately, these are decisions and topics that ultimately lead to a successful retirement for you guys. We do have, ExxonMobil content specific. We do produce more educational webinars, throughout the year. We encourage you to join those. We also have, podcasts as well, and now in-person seminars. We encourage you to engage in that, and you can find that information on the bogartwealth.com website. Comprehensive planning. All right. You'll notice that at the center of this is the financial plan, your plan. No matter what we discuss today, discuss an advisor on one-on-one. All conversations, discussions is going to lead down the path of running a financial plan. And you will hear me say that multiple times today. Again, I'm in this chair today speaking to you because I believe that everybody needs a financial plan. But what that entails, we'll look at cash flow withdrawal strategies. There's a tax planning optimization. Of course, from investment management, we want to tailor to your objectives, goals, risk tolerance. We'll look at estate planning, trust reviews, and that legacy component. What happens after we're gone or something happens to us. Review and monitor. And, it's not like we put a strategy in place and that's it, right? This is a constantly evolving, market conditions change, life changes. We want to be prepared and flexible to anticipate those changes. So today's agenda, introduction. We will be looking at planning and retirement. We're going to break it down into different segments for over a year out, less than a year out, and then at retirement, and then post-retirement as well. So planning over 1 year out, what we need to think about, right? What is on the top of our mind? Quite frankly, we want to know the rules to the benefits that we have. What's our pension rules? What's the tax situation of the different buckets of money that we've accumulated? What are my options with the 401k? We want to know our choices. What investment options do I have available? Knowing the savings plan, we'll go into a little bit more detail with the options around that. Again, to highlight that point, it says run your numbers. Do a plan. I can't emphasize that enough. We're going to look at evaluating our contributions and what we're adding to our plan. And then, we're going to consider, hiring an advisor. So why is it planning? Why is planning important? It's a comprehensive, objective financial plan, right? The process is designed to help prevent you from making the wrong decisions, based on emotions. We often hear about taking the emotions out of investing in the planning. It's sometimes a little easier said than done, but having that, financial plan as a core, as a foundation, acts as a lighthouse, and it helps guide us through life, right? It's not that necessarily this is how everything's going to change, but we really let it drive the conversation as we contemplate the different scenarios and outcomes in our head. Now we put it into a professional environment, we stress test it, and then we're more prepared in nature. And when we talk about prepared, it's for volatile markets, life events, our expenses, unforeseen expenses that come up. We're going to talk about the Pension Protection Act of 2006. This is a big key component for the benefits that are available. It limits companies from offering lump sum options, defines the discount rates that can be used, defines the actuarial tables to be used, your life expectancies in there. We talk about the after-tax balances that can be rolled over into a Roth account. Of course, the company match and how it can be diversified, and then defined IRA, 401k contribution limits in there. So which discount rate applies to me? The general rule is the rate in effect on the benefit commencement date. The BCD date is always the first of the month. For example, to get the second quarter discount rate for your BCD, it must be June 1st. So as again, the benefit commencement date, it's the first of the month. If we want the second quarter rate, then we must have our BCD date by June 1st is the latest. The grandfathered segment. I don't run into very many scenarios in this case, but your first available BCD date, then you have the option of choosing interest rate in effect on the first day of retirement. The first day of retirement is the first calendar day after the last day on payroll. The impact of the interest rate on the changes in the lump sum. I'll get right to it. The general rule of thumb is a 1% change in interest rate is a 10% change in the lump sum. That's up and down. You can pretty much assume that it's linear for less than 1%. In this example, we're showing an April 2025 versus a March 25 investment rate change, or discount rate. The rate is predicted to increase by 37 or 37 basis points of a percent. That was a little bit of a typo there, but what that means is if the rate increases, then our lump sum is going to decrease by 3.7%. On $1 million lump sum, that's roughly $37,000 in difference there. So rates go up, the lump sum goes down, rates go down, lump sum goes up. A little bit of an inverse relationship there. And again, the rule of thumb to emphasize here is a 1% change in the interest rate is a 10% change in your lump sum value. So our 401k contribution rules. These are our limits that we have for ages under 50 and over 50. The new for 2025 that individuals, it is age 60 to 63. After 63, it goes back to the other rules, but we have a catch-up contribution of $11,250. Okay, and for IRA contribution rules, this is, it's $7,000 for each. If you're age over 50, that's your catch-up contribution of $1,000, so your total amount would be $8,000. Oops, excuse me, sorry for that. So Roth rules. So we were IRA, now we've got our Roth rules. Beautiful thing about a Roth is it's tax-free growth. It's tax-free withdrawals as long as we've had contributions and the account's been up and running for 5 years. There's no required minimum distributions in it. And then from a legacy component, your beneficiaries inherit the Roth account and they get tax-free growth and tax-free distributions just as you would. It is a part in tax diversification. The difficulty of it is getting money into it, being able to make contributions, and that's with the income limits that we have. We do have, additional seminars that go into much more detailed and a level of analysis within Roth, versus, traditional 401ks and IRAs as well. But so how do we get it? How do we get money into a Roth? The most popular one is a backdoor contribution, right? Anybody can do this as long as we have earned income. This is where we are making a non-deductible contribution to an IRA and then immediately converting it over to a Roth. We can only do it as much as we're allowed to contribute to the IRA, which is limiting in how much we can get to it. But the benefit is there, right? We get the tax deferred, we get tax-free growth and tax-free distributions later in life, as long as it's within, it's been open for 5 years and we're age 59 and a half. The 401k, there is an option there for the mega backdoor. The mega backdoor is where we, after our after-tax contributions have accumulated, they are invested and contributed to the 401k. And then what we do is called a mega backdoor deposit, where we roll over the after-tax assets, amount of it into a Roth IRA. The mega backdoor, comes from the name comes because we can accumulate after-tax contributions. And I've seen cases where we've had 25, $50,000, $100,000, $200,000 to where we've been able to roll over into a Roth. Hence that's higher than the $7,000 doing a regular backdoor contribution conversion. So hence the name mega backdoor. Again, we do have other seminars and analysis that will go into this into very, very detail. When we're looking at our retirement benefits, specifically, with the ExxonMobil 401k through Voya, we want to look at our investment options, right? We should all be pretty familiar with this. Of course, we have the ExxonMobil stock, the equity units, extended markets, the international bond units, balanced and common assets. We're going to go into a little bit details of what those options entail. When it comes to the Exxon stock, of course, single stock has a higher risk with it. But if you believe in the company, you believe in the earnings, the outlook thing, it's not necessarily I can think of worse concentration, stocks and companies to hold than ExxonMobil. NUA, and we're gonna touch on that a little bit later in this discussion. Again, we have another, seminar and educational series that will go more into this detail here. But it is more of a post-retirement strategy that we can exercise net unrealized appreciation on the Exxon stock. So NUA, what's the deal? In essence, it is a tax strategy. And it allows us it only applies to the company stock, but it allows us to move company stock from a qualified plan into a non-qualified plan. The benefit of that is from a tax advantage, right? So now, if we were to leave the Exxon stock in an IRA, we were liquidate it and we withdraw it, we would pay ordinary income rates on it. By declaring net unrealized appreciation, we take the Exxon stock from the qualified account into a non-qualified account, your brokerage account, and now we're subject to capital gains rates, on our benefit there, which our tax rates are lower. Of course, the more money that we take out of the IRAs, we avoid R&Ds later in life. And again, we're now exposed to long-term capital gains rates versus ordinary income if we leave it in the IRA. This is a visual of that. From an IRA standpoint, 401k, again, everything is taxed as ordinary income. When we exercise NUA, of course, there's tax that is owed on the cost basis of the total amount of shares that we declare through. But everything else after that is taxed as long-term capital gains. Again, we will go into more detail in this in another part of our retirement readiness scenario series. Reading your statement, we should all be familiar with this. Just to kind of go through it again, we're looking at our investment totals, our allocation between the investment options in there. Of course, this is broken out with dividends. Now we start to get into our before tax, after tax, general account buckets in there. And then we get into our, pre-87, post-86 contributions. That is our after-tax contributions in there. And again, this is where this highlights this, and this is very important because this is where we have options, right? This amount comes into consideration when we are looking at doing a mega backdoor. This is the after-tax money bucket that we can pull from for a mega backdoor conversion. But it is also valuable in declaring net unrealized appreciation, because now that we owe a little bit of tax on our total basis, we can offset that by using some of our after-tax contributions into the plan. Again, we're not going to go into that great detail of it, but I've got a whole nother analysis, and we've got series that will break into those numbers, break down into those numbers. This is just, further reading the statement. This is the cost basis of the stocks that are there. As we break this down in a kind of a rollover and declaring NUA scenario, what this breakdown would be is that now I've got this amount of Exxon stock that is now into a brokerage account taxed at capital gains rates. The amount that we didn't declare NUA on would roll over in kind in an IRA. Your equity units, your extended markets, international bonds, balance, everything else gets liquidated in a rollover scenario, and it comes over as cash. In this day and age, they still mail out a check. The Roth component. The Roth component is the after-tax amount. In this scenario, we didn't have to use all of it to offset the NUA or the tax on the cost basis. So we had leftover after-tax funds in there, which would get rolled over into a Roth IRA account. So reading your statement again, this one does come up quite a bit in terms of if you're age over 50 and above. You'll see the differences. This is our current payroll contributions, and this is what it looks like with our catch-up contributions. The catch-up contribution, it is a separate election. If you want to know if you're elected or if you have it, you will see the catch-up contribution line item here, and it is displayed in the dollar amount. If we have an increase in the payroll deduction, that is not equivalent to a catch-up contribution. So if I just went in there and upped my before-tax contributions in there, that would not be considered as part of your catch-up contribution in there. The equity units, going into the details, this is, pretty much tracks your S&P 500 index. It's 500 largest U.S. companies. Represents 70 to 80% of the market value of all publicly traded U.S. companies. Our extended markets, looking at an index to compare against, would be your Wilshire 4500 index. That's mid and small cap U.S. companies. It includes all the publicly traded U.S. companies, minus the S&P 500s. The international units tracks the EFA index. I don't want to butcher the way that it's said, but it's Europe, Australia, Australasia, I believe, in the Far East index is the breakdown of that. But I'll just stick with EFA. It's large mid cap companies across 21 developed countries. As an example, Australia, Austria, Japan, Switzerland, Spain. In the UK, currently there's 918 companies representing approximately 85% of market capitalization within each country. In the fixed income or bonds, is the averages the Barclays Capital Aggregate Bond Index, represents approximately 17,000 bonds publicly traded within the U.S. and it is a mix of government, corporate, and mortgage bonds. High yield muni bonds, inflation index, bonds denominated in non-U.S. currency in there as well. So it is a very diverse exposure into fixed income. Your balanced units is actually made up of the other investment options within the Voya plan. That's a specific breakdown. 35% is your equity units, 15% is your extended, 25 is your international, and 25 is in your bonds. Common assets. It's basically a cash equivalent. The target is a $1 NAV target. dollar in, dollar out, plus your variable yield. And generally, it has done fantastic over the last few years with generating a higher yield. But it targets a little bit better than a money market for comparison purposes. As part of retirement as a year out, we want to look at our contributions. How much? Which investment choices? What are our tax consequences with after and before tax? And then our tax paid balance, which is our after tax contributions that we reviewed within the VOIA statement in there. Savings plan options. As we get closer to retirement, this is a scenario with a 401k that, hey, we can leave it at VOIA if we need it. We can roll it over to an IRA. We can take a lump sum distribution of the assets, or we could roll it over into annuity to create a stream of income. The lump sum distribution is the only option in which allows the exercise or execution of net unrealized appreciation in there. Lump sum or the annuity. If you annuitize, it's a fixed cash flow. You have options to create income for your single life or a joint life. It covers you, and then if something were to happen to you, your spouse would benefit from a income stream in there. Excuse me. As we consider why a rollover, the number one out there is professional management. Reduce stress. We expand choices and flexibilities. We saw that in the VOIA plan. We've got a limited amount of exposure that we have. Just as an example, we can start looking at real estate investment trust REITs, which are a good vehicle to generate income. International bonds, alternative investments, covered calls, another way to generate income if we want to liquidate out positions. And then you get pricing and control and sell power, greater power, by using good to cancel and limit orders on your positions, and specifically around the Exxon on stock. We can set those limited orders. We can't do that within the VOIA plan. Fixed income choices, of course, we can do individual bonds. We can lock in yields, better yields in there. Of course, all that is on risk dependent and objectives that come, with a financial plan. And then it's just more flexibility and options, controls to access, your cash flow, and making sure that we have a withdrawal strategy that's in place. So determining your retirement income need, typically, you start looking at all the sources. We'll go through it, an example here in a minute. But it usually tends to make up Social Security, pension plans, IRAs. Of course, we got personal savings, brokerage accounts that we've accumulated over this time. And then, there's also the opportunity or the option to continue to work or have some kind of contract work or just bring in some type of income during that time frame. The other way to look at it is predictable, sustainable, and potential to grow. Sources of retirement of income, the Social Security. This first statistics always, kind of every time I go through this, it kind of jumps off the page, surprises me. But it replaces 90% to less than 1% of the population in there. So it was never meant to replace, retirement income, but just to supplement it. So what does supplement look like? For a U.S. median income, replaces approximately, 40% of your income. For your typical oil industry employee, it would be anywhere from 10 to 30%. Pensions, of course, it's a fixed annuity. It's designed, aimed, targeted to replace up to 12 to 70% of your earnings, depending on that benefit. A lot of that's depending on age, service, Social Security. We all should know that their pension calculation is our 1.6% times years of service times average pay, minus the Social Security offset. For a typical career employee, it's roughly replaces 50% of your income at a benefit that grows up to at target age 60. And then, of course, we've got savings and investments. Again, that's your 401ks, IRAs, your thrift savings plans, others. But that's how we got to fill in the gap to generate, the funding for our lifestyle. So why is spending so important? I love this chart. It is very meaningful. When I look at a scenario, this is pretty much the number one thing that I look in terms of a health check, right? Making sure that my assets, my expense profile, I'm in a healthy ratio in there. But what this shows is the impact of withdrawal rate has on my investment portfolio and how long it would last or provide me income. Under this assumption, it says, hey, our investment return is 5%. Our rate of inflation, which our living expenses would be 2%. So our real rate of return is 3% in there. So if I have a 5% withdrawal rate, my portfolio will last 29 years. If I have a 4% withdrawal rate, it lasts 42 years. And then if I have a 3% withdrawal rate, while the chart looks like that it goes and goes on forever, at some point it does start to turn. That's roughly 99 years for 3%. So when we look at it, and we're looking at a financial plan, there is a heavy emphasis on withdrawal rate and our spending, right? What is the ratio to our spending to our asset profile? Cash flow planning. Social Security, pension annuities, short-term liquidity, bond ladders, income investments, covered calls. How much do I need and where do I pull it from? And then I would add an overlay in there is the most tax efficient way as well. What do we pull from savings plans? If I'm before 59 and a half, we call that proverbially got to bridge the gap, right? At 59 and a half is when we can access all of our retirement accounts without potential penalty, right? If we access those funds before 59 and a half, we're taxed as ordinary income, plus there's a 10% early withdrawal penalty in there. So if we, seems to be a number that is, I see a lot of retirements at 55, 56, 57. When we talk about the proverbial bridging the gap to age 59 and a half, how do we do that? We look at our savings, our outside environments, our outside investments. NUA, again, remember that is taking the Exxon stock from the retirement account, and now we move that into a brokerage account. If it suffices, it can be used as a key piece in bridging that gap to age 59 and a half. Of course, if we can generate some kind of part-time or contract consulting work to bring in income during that period, the better. The 401k, there is a option. For most cases, you get, if you're age 55 and retired, separated from service, you get a one-time per year distribution from the Voya plan, penalty-free. In some cases, you get two, and I think it's more applies to your legacy mobile components in there. But for all intents and purposes, we're just going to plan that, hey, I get one distribution per year, penalty-free. 72T, I'm not going to recommend that. I like to avoid that if possible, but it is an option. And basically, we would be annuitizing equal payments up to age 59 and a half of our retirement assets there. We've got to turn it on, and we're locked in for a set amount that we have to withdraw for a set period of time. Line of credit, it's just another options that we have to bridge the gap. So tax planning, it's important to know, which buckets that we have to withdraw from, and then what are the tax consequences, from that. We want to minimize the tax liability. Just to kind of go through this, your Social Security of it, it's not, it's typically taxed as 85% as ordinary income. Your pension income's taxed as ordinary income. Interest is the same. Your IRA, 401k distributions as well. Your qualified dividend income, so you have dividends that are taxed as long-term capital gains rates. Long-term capital gains rates, as mentioned, are lower than ordinary income. I think the next slide here will display those percentages. And of course, anything with Roth in front of it, we have no taxation on it. And then liquidation of investment principal, right? That is, hey, we're putting after-tax money into work. We can always get our after-tax money back that is not subject to additional tax. It's already been taxed in there. This is just a visual of the rates of ordinary income tax rates versus the capital gains rates. The 3.8% in there is when we have additional income at a threshold. We have a 3.8% that is added on top of the capital gains rates. We covered a lot so far. We still got more to go, but it's complicated. Again, the objective here is you need to have a plan. I'll reiterate it. I'm talking to you today. It's a passion of mine, and I wholeheartedly believe it, that everybody needs to have a financial plan in place. Again, we look at it. I mean, it's cash flow, it's tax planning, it's optimization, it's investment management, it's legacy and state planning, and then we always want to have the flexibility and the options to change and adapt as life changes with us. To do the analysis, right? Again, when we talk about the analysis, I mean, we have a whole subset that goes into detail on every one of these, from a retirement planning cash flow. Do I take the annuity? Do I take the lump sum for my pension assets? Net unrealized appreciation, what does that mean? What is the tax benefit? What is the dollar amount that it saves me? The portfolio risk analysis. We want to make sure that the plan, your investments, your tax optimization is all in tune and working together, and your risk level has a lot to do with that. We'll look at Roth IRA analysis and looking at tax optimization in there through Roth conversions as well. We'll look at insurance, right? I mean, insurance is kind of the necessary evil out there, but we want to protect ourselves. Maybe we need to protect income, protect family members, protect business entities. I mean, it's a key component. Long-term care analysis. I mean, this is a kind of a hot topic item that is out there, and it needs to be planned for and recognized. Social Security optimization. A lot of that will be specific on the plan. And if you have the affordability to look at an optimization as in, hey, what claiming strategy or when to claim it will optimize my Social Security benefit throughout my lifetime in there. Your advisor, certified financial planner, and needs to do that. Needs to know your retirement plans. Needs to know the tax and the IRS rules. Has navigated multiple business cycles, and then also has experience with managing portfolios. Open to discussion. Various strategies. Provides financial planning based on your needs and risk tolerance. And then, provides regular portfolio performance and reporting. I would sum all that up into communication, right? Communication is paramount in an advisor and client relationship in there. And then ultimately, you want to speak in a way that you can understand each other, right? That kind of comes with getting along with each other. So now that we get to planning, less than 1 year out. So lights at the end of the tunnel. That last year goes by pretty quick. We start, retirement really has kind of three components from ExxonMobil. The retirement per se, of course, now our pension service is frozen as the last day on payroll. Our average pensionable pay is frozen on the last day on payroll as well. But then, from the health benefits, the big change is going from an employee group to a retiree group in there. Of course, that's added cost in there as well. Commencing the pension. We got to choose a benefit commencement date. One that's your timing, that's the financial plan, that's the rate environment, our age. Again, another call to making sure that we have that financial plan in place, especially if we're within a year out, less than a year out. We look at the pension. It's based on your service, your average pensionable pay, and then your age of your BCD date. I mean, this really matters, at age 60, because now our actuarial tables start to come in play there. And then we look at our distribution of the savings plans, right? That was our rollover that we can leave it there. We can exercise in UA if needed. Things you need to do, again, I feel like I'm beating this, but again, update the financial plan. And I never get tired of saying that. Determine the estimates of all your sources of income, generate a pension quote from your benefit portal. Consider, opening small Roth IRAs to kind of start the clock on the aging if you have a Roth source within Voya. Again, so we got to have the Roth open for 5 years, right? And we have to be age 59 and a half. So that timing, that clock is starting the 5 years countdown on that one. Review the opportunity for the mega backdoor Roth. And, that coincides with the net unrealized appreciation, because that after-tax money can be purposeful for both types of transactions in there. Partner with your advisor proactively to plan for tax consequences, various retirement dates. And of course, we want to establish accounts, link bank accounts. And that way, as funds come in, it's very seamless to generate a cash flow into your operating account, checking account in there. Planning, you need to know, or you need to think about at retirement. This is a kind of an ideal scenario timeline. As this example is, hey, we had a March 1st benefit commencement date, but this kind of just breaks down of a time frame to expect things. That 90 days before the benefit commencement date is when we are really kind of navigating the hub and getting started. We want to declare our benefit commencement date in there, and of course we want to inform supervisors in writing. So within that month, December into January in there, if we're not using the online process, the package comes within 2 weeks. We need to review our pension options, lump sums, annuities in there. We need to change the medical plan payment method. We do that through the portal as well. Review beneficiary elections. If eligible for Social Security, consider to start receiving that. Then the pension choices form received is by January 25th in there. It does have to be notarized in there with your spouse's signature, but we want to make sure that gets submitted. As we start to move into February and March, kind of the benefit commencement date, that lump sum rollover check, if done right on the time period, usually comes in within a day or two of the BCD date. Your supplemental pension check is paid out around this time. What do you do with it? You can hand deliver or send or use a prepaid envelope to mail your check, your lump sum rollover checks as well. But then we also want to meet and finalize our cash flow strategy, just to make sure, hey, here's the assets coming in. What is our investment strategy? What is my cash flow? What can I expect? When do I need to expect it as well? So that time frame in the March, now we're looking at the Voya plan. We're looking at MUA. We're looking at IRA shares, any tax that we may have there, and then the other units as they get liquidated into cash. What is our investment strategy going forward? The March 16th, this is now we've retired. We've been there. This is a general time frame of when we liquidate, or if we roll over the Voya plan, we can expect to start receiving those checks. I've done many of these calls. It's the check gets they estimate 7 to 10 business days. There is some variability in there as well. But if we do execute NUA, the shares are actually transferred to ComputerShare. You will receive a statement of that. You forward the statement over to your advisor, to us, and then we can transfer those shares, in kind there. Again, that's a time frame that usually that month two, it ends there in April. At that point, we're all said and done. We've transitioned. We've got investment strategy. We've got cash flow strategies in place as well. Should you delay the lump sum? That is a very popular question these days. Of course, we've had a uptick in rates. I can't really answer that question. Is really answered on an individual basis, and I need the support of the plan to do that. And then, quite frankly, it's your age, your expenses. What do we need? How do we implement that the right way? Quite frankly, if I'm 55, I'm retired, rates are going up. We think that rates over the long term may go down. Then we've got interest rate that could work in our behavior. Plus, we got a little bit of a discount by waiting to take the lump sum in there as well. So when to consider delaying it is, hey, we don't need the money right away. Again, before age 60, and then if we do expect rates to fall in there, then maybe we delay it. So your post-retirement, I think that timeline kind of went through this as well. Uh, Staying in the plan. The only way to utilize, Rule 55 if needed. That's leaving the Voya plan where it is, right? If we don't have the outside investments, we don't have that access to funding, leaving the Voya plan where it is. Again, we can take a one-time per year distribution from it, penalty free, right? So we pay our ordinary income, but we don't subject ourselves to a 10-year or 10% penalty in there. It just puts more of an emphasis on budgeting, to make sure and discipline throughout the year, because we have to go back to it. Now we subject ourselves to the income and the penalty in there. Of course, we want to look at, professional management. IRAs, they offer greater investment choices. I do have some personal opinions on that, in there and what we should have exposure to. But within the plan, they are, the options are limited, but they do have low expense ratios in there. And that's a discussion to be had between you and your advisor. We do roll it over again, the net unrealized appreciation. And if I want to you have a takeaway for that, it is at its basis is a tax strategy. And then of course we want to, potential to generate income using, covered calls. Normally if we roll over the Exxon stock in kind, we usually implement covered calls as part of our liquidating strategy and generating a little bit of income in there as well. Again, that is very specific to your individual situation there. How do you process the rollover? I'm going to shorten this real quick. I get on a phone call with you, advisor. Many of us here, we get on a phone call with you. You give us permission to, speak on your behalf, and we can go through that conversation and execute that with you on the phone. Typically, I would say the conversations go fairly quickly, but sometimes they do take a little bit of time in there. So anywhere from 20 minutes to I've had some last well over an hour in there. But most of the time that happens 2 weeks after retire. Of course, you got to go through the process. Voya has to verify, that you're separated from service, which means you're eligible to execute on those options there. You do have to confirm that you received a tax disclosure, which discloses the different tax implications off of your withdrawals that you have, options that you have. We do tell the Voya specifically for the Exxon, the NUA on there, how many shares do we want to declare it on? What do we want to do with the remaining shares? And then we provide, IRAs, account numbers, addresses in terms of, mailing the check, who the check should be made out to in there. But we got you covered on that one. Other considerations. If you're eligible, the additional payments plan, supplemental pension payments, be sure to take this into consideration for your cash flow. That is paid out and taxed as income after you retire. If you select a lump sum pension option, then you'll need to pay your healthcare premiums, directly. And quite frankly, you log on, you set it to debit your operation, your bank account, and they'll debit those premiums right out of it. If you have RSUs, this one comes up quite a bit. Of course, if we've still got that vesting schedule that's out past our retirement, you will receive notification from Morgan Stanley soon after, that provides information on a new account. The purpose of that account is to receive the dividends of your shares that are unvested, right? As they come vested, now you own it, the dividends are paid into the account that you have, but as they are awaiting vesting, those dividends get paid to your Morgan Stanley account. Your life insurance only continue 5 years after retirement, if you meet, certain criteria as well. One-on-one financial strategy sessions. Again, the whole purpose of this conversation, I hope you found it, insightful, and I hope it stirs the questions in there. But, again, all conversations, all discussions ultimately lead to running, a financial plan for you. I want to thank you, for joining today. I appreciate your time. I've enjoyed it. I'd be more than happy to answer questions. If you feel like this is appropriate time to engage, please reach out to Bogart Wealth. You can do it directly through our website. Again, thank you for your time, and we look forward to talking to you in the future. Thank you.